We are back to Real Talk with JT, another season, guys. And I'm bringing somebody from the field because I feel like this is something, it is so relevant, like super relevant, right? Mortgages. The industry is changing for the past 2 years. I mean, deals they falling out of escrows, people not getting qualified anymore. There's a lot of fear and uncertainty what the market's gonna bring, and it's all because of the mortgages. So I want to welcome today someone who's really special to me, good friend of mine, and also colleague, Peter Karlin from Go Rascal. Let's go, P.
Thank you, John. Good to be here, brother. Appreciate you.
Thank you, my
Appreciate you.
man. Always, always. So, Pete,
So,
before we jump into it, right? I'm a little curious. I know you really well, but why don't you tell the viewers a little bit how long in the business? What did you do before? What is sort of your background, and what will lead you to the mortgages?
okay. Well, let's start. I guess let's start with my background. Let's go. Let's
Yeah,
go back.
a
um,
little bit.
I'll go back a little bit. Right, cut me off. I may elaborate a little bit, so you just cut me off. So my background is I was an IT guy. I worked on Wall Street for many years in software development on Wall Street, trading floor of Goldman Sachs, which was really exciting, and other commodity companies. And then September 11th happened. I was downtown during September 11th,
Hmm.
and that was a sort of big turning point for the world and
Yeah.
for me because I had always loved acting. I had a love for acting, and I decided it was time to pack up my bags and leave New York and head out to the West Coast and go be a movie star, which I attempted to do. And as you know, I've been on a few television shows and a few movies and a few plays in New York and
Yeah,
Los Angeles.
Peter's famous, by the way. Peter's
Oh, I
famous.
am
Yes,
not
he was in the
famous.
Law and Order. Yeah.
I am not famous, but I've done some cool things on television. A few
Nice,
good television
nice.
shows. So then I it's difficult to break in and make a living in acting. So I came back to New York and did a couple of other ventures, and then I was at a point where I was sort of like, okay, what am I going to do with my life? And a buddy of mine was like, man, you should really try mortgages. You're good with numbers, you're good with people, you like solving problems, solving puzzles, which I find mortgages very much a problem solving thing every day. We're dealing with some kind of issue in the real estate world as well. So
Oh yeah.
January 2013, I jumped into the mortgage business,
Wow.
and I was like, oh my, and that's when I met you. Actually, I met you and your brother right in
Wow.
that
I
first year.
yeah, it's pretty incredible just hearing you say it 2013, and I just
13,
realized,
brother.
damn, it's been 10 years.
Yes,
We're
sir.
growing old together, P. I got few gray hair, in the
Yeah,
meantime. So
they're
it's all
going
good.
back. Yeah. So and it's been, I will tell you, it's been a roller coaster ride a bit. It's a
Hmm.
challenging field, real estate mortgages. But I don't have to. I mean, I could speak for you as well that it's pretty amazing, right? When we help someone get into a home, especially a first-time home buyer, one of the biggest perhaps purchases in their lives, and you make such a big impact on somebody when you get them into a home. So it's pretty cool.
Hmm.
It's pretty cool. And yeah, and we're in a chat. So you had asked me. I'm so sorry. You asked me about my background, and then what else did you want to
Yeah.
know?
Yeah, I mean that's great. And I know 2013 you started in mortgages, and at that point of time, I think the market was sort of coming back already
It was. That's correct.
from the meltdown, right?
Yep.
And now it's completely different. So you went through 3 4 transitions which we had in the market, right? COVID, inflation, war in Ukraine, the elections, and there were different bumps along the way.
Yep.
But how do you feel about the mortgage industry? Like, how did it evolve for the past 10 years? And is it positive? Is there some negative stuff as well? And what would you say it's one of the one to two things we as agents, we should look out for in today's market?
Has it evolved? Absolutely, it's evolved. I think especially now what we're seeing so much of in the last, I mean, when I started in 13, right, FHA, conventional, VA loans,
Hmm.
those were now, as you know, John, we have non-QM, right? Non-QM has taken over, I think,
Yeah.
bank statement loans, right? And when I say non-QM, I mean non-qualified mortgages. So it's your non-traditional mortgage, right? Which where you're qualifying someone not on tax returns, not on pay stubs, not on
Hmm.
W-2s, right? Where you're looking at alternative ways or methods of income calculation, right? Debt servicing, as they do in the
Hmm.
commercial world, right? Bank statement loans, 1099 loans, asset based loans. So there's a lot of, you know, they say, light doc loan. It's not really a stated sort of almost close to the stated programs and from years ago, right? So yes, it's definitely evolved. I think it's constantly changing. Listen, in today's market, the big
Hmm.
deal is interest rates, right? It's that whole thing. It's
Huge.
a big topic. What do we do? But I'll tell you something. It's pretty crazy. Myself and a lot of the folks I work with, we've been busy. It's not stopping people from buying. Because the other thing I always tell people is, listen, you get that higher interest rate now, and you're going to see probably more deals happening now, I think, than you will number of months down the road, because interest rates are high and you can always refinance out of the rate that you get in today. Right? People sometimes forget about that. Oh, yeah, but I'm at a 7%, 7.5%. What am I going to do? 8% on a non-QM? What?
Hmm.
No, what you're going to do is you're going to get into the home that you really love, right? And then in a number of months, maybe a year, you're going to refinance out, and you're going to get another mortgage. I mean, the other options are, I tell people today, is that adjustable rate mortgages, the temporary buy
Hmm.
downs. We
Yep.
did a session together a couple of weeks ago on the temporary buy down. Right, there are
Yep.
solutions.
Yep.
There are alternative solutions to how to handle the high rates of today.
So there's more options now, which I think it's great to have, right? But now I'll ask you, back in 06, 08, we also did have, non-traditional mortgages, right? We had the piggyback loans, the 80/20, or the, 120% financing. And a lot of those loans, the submarket loans, right? They actually had a huge impact on the market crashing, right? So
Yeah.
are we going to see a same trend with these loans going bad eventually, or you guys qualifying them differently?
No, you're not going to see that, because I think the government learned greatly from doing that. That was, I guess we call that over leveraging, right? You gave
Hmm.
these incredibly high loans, and there was a lot of things going on at that time, right? You talk to an appraiser and you tell the appraiser, hey, this is the value that I got to have, you got to get it for me, right? Now
Yeah,
you cannot talk to
combination
an
of
appraiser
things. Yeah.
now, right? There's
Hmm.
that separation now. So there's a lot of checks and balances that I think are in place right now that will prevent that from happening. And you have FHA. About the FHA just recently dropped their
Hmm.
mortgage insurance premium, the MIP, by 30 basis points, which equates to
That's
approximately
crazy.
35% in the monthly mortgage insurance, which is wonderful. It's going to make a
Yeah.
big impact for a lot of home buyers. And then we have so
Hmm.
many, we have down payment assistance loans today. We have 3% down for first time home buyers, in addition to the FHA of 3.5%. So there's a lot of really cool, good loan products out there that,
Hmm.
fit a lot of different situations. And that's what a mortgage person, a mortgage loan officer that you work with. You need to know somebody or be connected to somebody who has, the knowledge of the different products out there to sort of fit. You want to fit the scenario of the borrower. That's I think that's one of my strong suits is that that you got
Mm,
to be able to you got New York state of mind. Yes, sir, Josh. Absolutely.
I love it. Yeah. And I mean, this is so good. I mean, we know that one size doesn't fit all, right? And just having, more
Right.
options for people, it gives them, availability to do different things, like right now, don't have to wait.
Yeah.
Now, let's talk about the basics a little bit, P, because I know today, we're really going to talk about what are the basics for us as real estate agents, which, we should be aware of. And I also feel like, the agents really missing on the process. Like, a lot of the agents, they don't really know much about the mortgages, right? So they kind of relying fully on the banker, which I mean, it's fine, right?
Mm,
But again,
mhm.
knowledge is power, and the more we know, right,
100%.
the better we
100%.
can really guide the customer and also make the job a little bit easier for you, right? If we can tell you, hey, listen,
100%.
this is a DTI, this is the
100%.
qualification, I got the DAX. So why don't you walk us through some of the basic terms, so maybe like a different loan programs, conventional, versus FHN, the non-QM, right? You kind of talk about that. But then
Mm.
also, what's DTI and how does that work? And then what traditionally the process is for the buyer to get pre-approved. And then you can show us your mortgage calculator, which everyone, guys, you're going to love that mortgage calculator. I mean, since being how many years it's been since you created one? It's been few years back, right?
you know, I think I started it towards 2000. It sort of evolved over time, right? So I
Yeah, for
started.
sure.
I think I'm a big, as I told you, I was a software developer and I worked on Wall Street. And I was a numbers guy, so I was also not only database development but Excel spreadsheets became my thing, and many people
Go
know
go
me.
to.
I got a lot of spreadsheets that I keep track of stuff. But I realized, when I was sitting with borrowers, right, you've got to have, there are a lot of different, listen, a lot of the mortgage bankers have a lot of,
Hmm.
and loan officers have their own spreadsheet or whatever. But I made this little simple thing, which you've seen hundreds of times. And a lot of the folks who are on this call have seen a lot of hundreds of times. And it calculates debt to income ratio, right? I mean, and that's one of the key components of approving somebody is debt versus income, right? How much money do you make versus what is going to be your debt? And
Yeah.
so I put together this spreadsheet that evolved over years, and people seem to love it. And I will give it to anybody who wants it on this program, and I share it. It's funny, John. I was on a sales call this morning, and shout out to Scott Valens. He mentioned that we are as, and I'm going to include realtors in this as well. Mortgage loan officers. We're advisors, right? We're educators, right? That's how we're not salespeople. We're not going to, you just give us your documents and, we hope that you get a loan. We have to advise you. We have to guide you. We have to know the rules and we have to know the guidelines.
Mhm.
And as you said before, knowledge is power. The more you know about the rules and the regulations of the government of buying, and you do the same thing, right? You do this. I know you're a coach as well, and that's, you coach people, you learn how to coach and what to say. So it's extremely important. So I want my realtors and I want my buyers to know how to calculate debt to income ratio. I want them to know how the loan programs work. I want them to know. Oh, Jason Pierce, good to see you. Absolutely, I will. I want people to have that information so that, when we it's just like, children, right? When you bestow knowledge onto somebody, they frequently they want to learn more from you and they become more attracted to you, right? I want people
Mhm.
to be attracted to me, and you want people to be attracted to you, right? Because
For
if they're
you mean for business, right?
yes,
Okay.
thank
Full
you.
disclosure, guys.
Yes,
Okay.
thank you. We're both married men, happily married. We want to stay that
Yes.
way.
We're not looking for that attraction, ladies.
Right on. Thank you for clarifying that. So the more we feed people with knowledge, the more they're going to be connected to us and trust us
Yeah.
and like us. And it's all about building a trust and a bond, that people feel comfortable with.
And
Thank you,
and,
Monica.
and you know what, P? It's amazing, right? Because like to me and you, the spreadsheets and calculating the monthly payments and the DTI and all the good stuff for the consumers, it's like, yeah, it's basic. This is something we need to do. I'm
It's
talking
so
to other
crazy.
agents. They're like, oh my god, this is brilliant. The spreadsheet is like it's unbelievable. How uh, how did you think about this to do this for the buyers? I'm like, isn't this something we're supposed to do? I mean,
That's what I've said. I say that. I'm like, oh my God. And I meet people who have sat down with other bankers or other mortgage loan officers, and I said, well, did your loan officer like go over this with you? Did they explain it? No, no, no. I'm like, well, that's a shame. That's like terrible because I want you to understand what you're getting into, because I would want it's basically, listen, treat somebody how you want to be treated. I mean, that's the bottom line, right? Yes, we're here to make money, and yes, we're here to better ourselves as well. But you got to treat someone the way you want to be treated, and then it's all about, to me, referral business, right? People
big,
will refer. Oh my
yeah.
God, John Tayeb and his team. They took care of me. They educated me. They held my hand. They were there when I called them at night. Blah blah blah. And that's what we want. That's what we all want. I think most of us want anyway. So yeah,
No, the service matters, man. I agree with you. It's always serve first and sell second. And if you focus on the needs and the wants, of the customer and who the customer is and what he needs, eventually the business is gonna find you. So
yeah,
Pete, do you want to go into the spreadsheet? Do you want to take us behind the
sure.
scene a little? By the way, guys, I know if you're watching this live on YouTube or social media and you have questions, or if you're watching the recording, because this is going to be recorded as well, just dropping down below anything mortgages, just shoot a message to us. We'll get you the answers.
Okay, so hold on one second. I had some technical difficulties earlier today, so I had to
All
switch
good. All good.
computers. I had to switch computers.
Guys, if you find this helpful, give us some thumbs up. If you don't, just give us thumbs down. Like, let us know
No,
there's no
no,
value for
no, no,
you.
no. We don't want the thumbs down. Don't send the thumbs
Yeah.
down. Only up.
We'll take it
Just
all.
kidding.
It
I'll
helps
take
the
it. Yeah, I'm
algorithm, they
kidding.
say.
I'm
So
kidding. I'm kidding.
thumbs
I'm
up, thumbs
kidding.
down, sideways. It's all good. Just let us know you're still there and watching. And of course, if you find this to be helpful, share it with people you think they can take advantage of it as well.
All right. So, John, just tell me, how am I sharing the screen?
Click on present in the
Present.
Mender.
Got it.
Uh, do the slide
Slides.
like we
Okay.
did. Boom. Select it
Okay. Okay. I got you. Thank you, sir.
and share it over there. Boom. And once it comes in, and I'll bring it over.
Okay. So I just, oh, it's okay. It's uploading. Thank you guys for being patient. Apologies. And there we go. Oh, it's processing. Okay.
So P, in the meantime, so what are some of the terms like DTI, the front DTI, the back DTI, conventional, FHA, non-QM, like what does it stand for exactly, DTI?
So, all right. DTI, debt to income ratio, right? Debt versus income. So when we're dealing with, right, and there are different loan types warrant or have different ratios, different debt to income ratios, right? Pretty much the standard is somewhere between 45 to 50%. Okay, so if you're a W-2 person, right? You're W-2, you're getting a paycheck, or you're getting taxes taken out of that check, then we look at, in the mortgage business, we look at the gross income, right? The gross income before taxes are taken out. If you're a self-employed person, and there are different types of self-employment, right? There's 1099, there's, you know, you report it on your personal tax return versus a corporate return. We look at the net income, right? We go to the net. What's the net? The net is after you take all the deductions. Why do we do that? Because we know that self-employed people will show they show as much as they make on the gross, right? And then they take all these deductions, and then they come out with a net. Sometimes that net could be zero or negative, right? Sometimes people make $500,000 or whatever, and they net down to zero. Well, the mortgage banks and underwriters, we look at that net number, because that's the number we assume this is what you have left over to go buy a home. So what we do is we take the monthly total. I mean, you'll see it on the spreadsheet when we bring it up. Is it up, John? Can we bring it up?
Yeah, let me bring it in.
So let's go a number of slides in, and you'll get to the calculator.
Oh, look, we got some thumbs up.
Oh yeah, cool. Thank you.
Sideways from Monica. I love it, Monica. Does it go left or right? Which side does it go to? It's important too.
Go to page 11.
Oh, you moving it, right?
Slide 11, John?
Yeah,
Are you doing this? Slide 11.
Yeah, I don't think you have only. Yeah, there you go. There you go.
Okay. So this is the famous calculator, everybody. And everything, the fields that are in dark green, the dark green fields are user entered. They're my user entered fields. Okay. And so let's start from the top, and we'll work our way down. Okay. So in this particular example, it's a $760,000 loan amount with 20% down. That's $152,000. Total loan amount is, $760,000 purchase price. Loan amount is $608. Now do note, by the way, I have another spreadsheet like this that works for an FHA loan. This particular loan example that I'm doing right here would be actually it's either a conventional or a non-QM. Actually, that rate doesn't matter. But
why do you have a FHA spreadsheet as well? Why having two different spreadsheets?
Well, you know what? I need to combine them into one, but the main reason is, and I can show that one as well, but when you deal with an FHA loan, you have upfront mortgage insurance premium as well as monthly mortgage insurance premium, right? So, and that's just part of an FHA loan. You know, people say, well, what if I put down 20%? Well, if you put down 20%, don't do an FHA, don't do an FHA loan unless there's some necessary reason you need to go FHA, which could be that you have a low credit score. Actually, could be that your credit score is really low, and you want to buy and you can't get a conventional loan, so you got to go FHA. But if you go FHA, you're getting mortgage insurance, and the mortgage insurance is upfront and is also monthly. That upfront mortgage insurance is actually a closing cost, which the FHA or HUD allows you to roll into the base loan amount, which everybody does, right? It's actually a closing cost. It's a closing cost, but they allow you to roll it into the loan amount. So,
which otherwise you really can't roll any portion of your closing costs into the loan amount, right? Unless it's like a seller's concession.
Exactly. I was just going to say that. Exactly right. Unless you get a seller's concession, where a seller's concession is the seller conceding, giving you a credit towards your closing costs. And because of getting that credit is basically rolled into the loan. right? So it's not like a gift, but it is the way. It's the only way that I'm aware of that you can roll closing costs into a loan. Correct. So, all right. So
Speechless.
we keep going on this. So
Mhm.
now we move to the income section, right? And this is these are three guys. It was actually this particular loan was two brothers and a father. This was their annual income, and then on the column to the right of that is broken down by month. Then if this was a multi-family property, right? If it was a 2-family, 3-family, I have a field in here. Again, we're looking at all the fields, but dark green, remember, is user entered. So then we have that field for the rental income. And on the rental income, we could take 75% of that number and use that towards your usable total income. Right, we use that towards your usable total income. So we add up all these guys, these three guys, their income's $10,617. Then we take debt. We look at the debt that someone has that's a minimum monthly debt that would be taken off of their credit report, and or other loans that they may have that are not on the credit report, right? And we're specifically in our business, we're looking at the minimum monthly, right? So if you have a car, you have $30,000 left on it, your payment's $520 a month, we want to know about the 520. But actually, interestingly enough, we also want to know how many payments are left, because if you have 10 payments or less, then we could negate, and it's a finance, it's an installment loan, we can take off that loan, right? Because the government's saying, hey, if you have 10 or less, you're going to be done with it soon. We'll wipe it off your debt ratio. You could take it out of your liability section. The other thing is
Now,
student loans.
how about if you have loans where you co-sign for someone, let's say on a car or even a mortgage?
Great. So if you co-sign with somebody, and you see on the credit report like a joint, you'll see joint, J for joint, that you are joint borrower.
Mm-hmm.
If that other person has paid for that for whatever it is, that loan, in a timely fashion over the prior 12 months, that you're going into a purchase, and we can prove that other person is paid from their own account, an account that you're not on. It's got to be a bank account that you're not on for 12 months going back. Then we can take that liability off of your debt ratio. Take that out of your debt ratio, right? So that's a great question, John. The other big thing that comes up a lot of times is student loans. For student loans, if people say to me, oh, I got a deferred student loan, I have my, it's a zero payment. No, unfortunately it's not. We have to take into consideration some payment for you. So depends on the loan type. Freddie Mac, FHA, it's if there's no minimum monthly payment on your student loan, we take 0.5% of the total balance. If it's Fannie Mae, we take 1% of the total balance. And then you can also get, if you think that, getting if you call your student loan people and ask them for, I think it's an amortization. Say again?
Yeah. Amortization
right?
of the loan, right?
Correct. If you take an fully amortized payment or something like that, and that's better than the 0.5% or the 1%, then we could, and it's documented, then we can show that. So student loans, regular loans that show up on credit report or not, car loans, credit cards. Sometimes it's like I have it's an interesting situation right now. I have a young man, he actually works for Honda, and he's got a student loan that is getting in the way of his ratios to make him qualify. So I said to him, look, can you get that loan? Can you get that loan in somebody else's name? Transfer the loan. Get it off your
Oh, wow.
transfer somehow.
Or you could transfer the student loan to someone?
No, not student loan. A car loan. It's
Car
a car
loan.
loan.
I see. Okay.
It's a car loan. Yeah, you're not gonna be able to transfer the student loan, but not to my knowledge. But there's ways. I'll instruct people to pay down credit. Hey, you got to pay credit down. You could also pay credit down during the loan process to qualify for things. So that's a whole nother, we could do a whole session on credit, because credit is extremely important. You know, I tell people, excuse me, you really want to keep your credit clean, because credit has, as you know, John, has such a bearing on getting a loan, right? On your interest rate, right? People always want, I want the best interest rate in around. Yeah, I want to give you the best interest rate, but you have to have top tier credit. Typically, we're looking for 740 or above is top tier. Some cases it's 780. But typically it's 740. So, all right. So that's
so I know, Pete, just quick. So I know for the credit card debt, you take in the minimum payment, right, into the calculation to calculate the whole thing. So if you owe, $20,000 on a credit card and your minimum payment it's $500 a month, right? You will calculate the $500 a month. That's going to go into that calculation, not the whole amount. Okay.
No.
So just clarifying for you guys, because I know sometimes that gets confusing. How about past due taxes, property taxes, past due taxes? Let's say if there's a taxes due, income taxes, property taxes.
Right. All right. So you just mentioned two things. So let's break that down. First, income taxes. So if you owe past income taxes, you either have to be in a payment plan or you got to pay the taxes. We're not going to let you, close if you owe the government money, right?
So if you owe money to Uncle Sam and you are on payment plan and you pay $500 a month, you will take the $500 and you'll add it to your debt. Basically, that's what it is. And if there's a balance due and you are not on the installment plan, then that has to be taken care of. Either pay that off, clean that out, or get on the installment plan. Okay,
correct.
Sweet.
Correct. Very, very important, man. Good point. Past due property taxes. Yeah, you gotta, if you're so you're talking, if you past due means you're either a seller and you're past due, right? Or you're a buyer and you own a property and you're refinancing, or you're looking to buy another property. Yeah, you can't, the bottom line is you got to get all that stuff current. You got to get all that stuff has to be current, right? I had an interesting happening years ago. The guy jumped his electric meter. He lived in a multi-family home.
Nice.
And he's pulling the electric from his, from his I think from his other unit.
Wanna be electrician or something like that?
Somehow
he's lucky that the house didn't burn down.
He racked up close to $20,000 of owing to Con Edison.
Nice.
And they were like, no, if you pay us, yes, if you have to pay that bill, and that has to, you either pay it at the closing table, we'll take it at the closing table, or you pay it before the closing table, but we ain't letting you close without you paying that bill. So, you want to be responsible. Listen, here's the thing I tell people. You're coming to a banker, you're coming to a bank to get $500,000, 500,000, $500,000, yes, same thing. 100,000, 50,000, whatever the amount is, right? You need to be responsible with your bills, right? When you get into a mortgage and it's a 30-year connection to the bank. Right?
It's a big commitment. Yeah,
it's a big commitment. Think about if you were lending your own money. You want people. You want to getting connected with people who are responsible in paying their bills, let alone a $3,000, $4,000, $5,000 mortgage payment, right? So yeah. Any other questions on that, on debt, on credit?
Any other questions, guys? If you have questions, just drop it down. We'll get an answer. Keep on going, P.
Okay. So, and by the way, one of the things that I do is I do help people, and I do help people with their credit, right? To get their credit. Like sometimes it's taken many months, and I have a great credit expert that I work with who does magical, very, very cool stuff, very helpful stuff for people. But you want to get your credit prepped up and looked. A lot of people say to me, oh, I don't want to run my credit because I don't want to, my score to drop. Scores drop typically if, or scores drop based on a number of factors, one of which is how many times you pull your credit. A misconception is, right, if you're shopping for a mortgage or you're shopping for a car, you say, oh, I don't want to keep pulling my credit. We know, or the credit bureaus know, that you're in a shopping mode, right? So if within I think it's like a 30-day period, if I'm not mistaken, that you pull your credit from different banks, or even if it's car financing, you don't keep getting a credit hit. Yes, you get an inquiry on your credit report, but you don't drop in points. And typically, if you already have a good score and you're pulling credit, you may drop a point or two, if anything. Sometimes you don't drop at all because you have built up such good credit. Now, adversely, if you're someone who, I'm going to apply for this credit card and that credit card and this store and that store, and I'm going to go car shopping, and you have all these inquiries, and you have high, medium to high utilization, yes, your credit scores are going to drop, a bit more than that other person, right? And I don't have a formula to say how much, or I don't really know how many points is it going to drop. Can't really tell you. But I know based on those things that you could do that. Now, a great website to go to, everybody, is annualcreditreport.com. Annualcreditreport.com used to be you could only pull for free once a year, but I think they've changed that, and you could pull more frequently. And it's always a good idea to pull your credit at least once a year. Why? Because you want to see, a lot of people say, oh, I know exactly how my credit is. I know my cards, I pay on time. Yeah, but here's what you don't know. What you don't know is if somebody else put something on your credit report, or somebody else opened up an account in your name and you're just unaware of it, right? Or I've had this situation. I've had a client that they didn't pay, they paid Macy's everything they owed Macy's, but they didn't pay like interest on their balance, right? Interest.
At the end, it came like 30 days later, and they were thinking it's paid off, and $25 stays there for 2 years, and it screws your credit completely.
$3, $2, right? But it's late is late, right? Late is late, and it was terrible. And unfortunately,
the same thing happened to me with the National Grid.
Oh, that's right. You just told me about that.
I'm dealing with the collection of my credit right now. It's not my bill, but my extended didn't pay the bill, and National Grid, they put it on my name.
Yeah.
My credit dropped from 8 to like 640.
Oh my
in a year and a half, and I didn't know. And the moment I find out, when I was applying for the loan, I find out, John, your credit's like 640, man. I was like, what?
And see, that's why I tell people you gotta stay on top of your credit. If you move
once a year, guys.
Better to know that you moved. People tell me, oh, they sent the bill to my other address. Yeah, but you didn't. Is their fault that they didn't know the new address? You didn't tell them. Now, sometimes the creditor makes mistakes. They make mistakes. Fair enough. And if they do, and you go, you dispute with them, you should win. But if they didn't make the mistake, they're not taking it off. It's
kind of like getting a parking ticket, right? Or getting a ticket, and the cop puts a mistake. He writes down license plate wrong. He misspells one letter. Automatic dismissal, right?
Yep.
So keep on going, P. What's next on the spreadsheet?
Okay, so now we move into the bottom part of the spreadsheet, which is the monthly payment, right? The monthly payment. So the monthly payment in this particular example, and I'm not sure.
You got muted, P. It's on the computer. I think you can just unmute yourself on the computer. So, do you find this helpful, guys? I think your mic got unplugged or something.
Jake,
There you go.
me?
Yeah, you back.
Okay. Okay. So, so now, right, 6.75% interest rate on a 30-year fixed loan. Now, here are the 4 components, and could be 5, to a mortgage payment, right? You have principal and interest, which is the principal amount that you've borrowed that you have to pay back, and the interest that the bank is charging. And that always stays the same for the life of the loan. Stays the same for the life of the loan, right? So in this particular example, it's a $608,000 loan amount at 6.75% interest on a 30-year fixed, 30-year amortization period, and that yields a $3,943 per month payment, right? Then you have property taxes. In this particular example, it was $5,800. This, I think, was a house in Queens. It was about $5,837 a year in property tax. Divide that by 12, you get $486. And then homeowners insurance to protect the house from any major issue. About on this particular example is $1,126 for the year. Divided by 12 is $93.83. Add those all up, you get $4,500. Now, right, and now the other component. So that's 4 components, right? Principal, interest, property tax, homeowners insurance. What could come up, and frequently does, if you're putting down less than 20% or you're doing an FHA loan, is mortgage insurance, right? So mortgage insurance, for an FHA loan, mortgage insurance is a function of the loan amount, how much you're putting down. Loan amount and how much you're putting down. For a conventional loan, mortgage insurance is a function of loan amount, how much you're putting down, and your credit. Right?
Wow.
That's
so
credit.
FHA don't care about the credit at all when it comes to the EMI.
FHA does not, they do
That's
not
interesting.
bother you with regard to the credit. Correct. They don't bother you with regard to the credit.
Nice.
So that's the nice thing. So typically if someone has less than favorable credit, right, or FHA may be the better way to go. It may be the better way to go. So, okay, now let's talk about the numbers on the bottom. And this is right. So we just went everything on top, numbers on the bottom, DTI. We spoke about that earlier, debt to income ratio. On a conventional loan, I typically like to see under 45. But in a number of cases, we could take it up to and including 50, even higher than 50 in some cases. Like 50,
unconventional loans.
Conventional. But it depends on the mix. It depends on the credit, depends on the down payment. It depends on a number of factors. But under 45 on DTI, on a conventional loan, I know this is going to work. This is going to work. So what is it? Let's talk about the DTI front end and the DTI back end. What's the front? The front is also known as a housing ratio, and that takes the proposed mortgage payment, just $4,500 here, $4,523, and divides it by the total income, $10,617. So if you divide those two numbers, you're going to get 42.61%. That's where that comes in. And then your back end ratio takes the debt that we have from the credit report, student loans, right? That's $226 here, adds it to the proposed monthly payment and divides that by the income. And that's where you're getting your back end ratio.
Very nice. Yeah. Yeah, no, totally. Now the back ratio and front ratio, I know you said 45 for the conventional. They both need to be under 45?
You know, yes. I mean, yes. Sometimes it varies, but if both are under 45, it's typically the back that we concentrate most on, under 45. But again,
the whole deck,
I've taken that back up to and including 50.4. But again, it depends on the scenario. I'll tell you, typically, if you're doing, like in this particular case, guys putting down 20%, I remember their credit was excellent. This could probably have gone up to 49.9 or even perhaps breaking 50.
What about for FHA? What is the Is it
So
45 as well
FHA,
for
so for
FHA or?
FHA on the front end, you cannot go higher than 46.99. 46.99.
Wow,
But
that's
on the
funny. I was
back
thinking
end,
you could go higher on the FHA than the than the conventional, but no.
the back end, the back end
I
can go
see.
up to 56.9.
Oh wow.
56.9.
Okay.
So like I have people who have debt, right? They have
Hmm.
car loans, they have student loans, they have credit cards, right? That's going to kick up that back end ratio, right? Because that's where the back end ratio goes higher than the front when you have that minimum monthly debt. So when I have someone, excuse me, who needs a little cushion, they need a little more breathing room, um, then perhaps it might be, in their income, it perhaps may be a time to look at an FHA loan.
Sweet. So
FHA. The other thing I'll just say on FHA, really good with 2s, 3s, and 4 family properties because the FHA will allow you to put down 3.5%. 3.5%.
on
You could
four
buy
unit,
what's that?
on 4 unit as well,
On
right?
a 4 family. Yes, sir. I mean that's tremendous. I mean you could buy over $1 million property, right, with
Needs
three and
to
a
be a
half percent
primary
down.
residence, though, right? Needs to be a primary
Gotta be
residence.
has to be primary.
Yeah,
Yeah,
yeah.
FHA you have to it has to be primary. Has to be
But I mean,
primary.
comparing 3.5%, versus what is it, 20% for conventional?
Uh you could so there are first time home buyer conventional loans for a single family where you can put down 3%. You can put down
Wow.
3%. Fannie Mae and Freddie Mac have these wonderful loans where you can put down 3. But if you're going multifamily, you're going conventional, minimum 15% down.
I see. Minimum 15. And how about, we get this a lot. Grants for first time buyers. I'm a first time buyer. It's like the golden ticket. I don't want to miss it. It's just once in a lifetime opportunity. Like, what is the qualification for that to be
So
considered a first time buyer?
there's a number of different down payment assistance. We call it DPA, down payment assistance. There's a number of
Hmm.
different DPA programs, grant programs, um, uh, and they all have like different qualifications. And typically, I mean, I could get into one of them, or I think maybe that's perhaps another thing we could take time on, but. You have to have a certain level of income, right? They don't want you to go too high because now you sort of seem like, well, you make too much money to get a grant, right?
Why? Yeah.
And then
Why you need a
also,
grant from us if you were making all the money?
I mean, they have different qualifications based on where New York City versus Long Island versus Westchester. They don't want you to don't make too much. Because they're giving you money,
Yeah.
right? They're giving you. I mean, there's something out there, and I apologize. I don't know a lot about it. I think it's called. I forget. It may be called Home First. They give up to and including $100,000, right? But there's
Wow.
a lot of restrictions to it, like and there's restrictions on everything: purchase price limits, on your income limits. The debt to income ratios are typically a lot more conservative than a conventional or an FHA loan. So
Hmm.
there's a number of, you have to be typically you have to be a first time home buyer. What's the definition of a first time home buyer? Well, actually, different programs. The definition of a first time home buyer is someone who has not had ownership of a property within 3 years, ownership of property in the United States within 3 years of going into contract, right? Then there's another program that says you just can't be on a property. You can't own a property when you start the program. So, but
that's on your personal name, right? Just putting it out there. So if you have a properties on your LLCs, is that considered your property, or they can see that, right? So it's really not.
so this is a very good question. and I'm 99% sure of the answer. I'm not 100, but 99% sure that if
99%. That's
it's
pretty high.
99,
But if you disagree with Pete, just drop it down in the comments. Like, let
I
us know.
also want to say
Because we
Pete
like to
Karlin
be a
said on
200% sure, not 99. Yes.
But yes, if it's under an LLC, it's not your personal name, and we don't see it, right? I mean, we don't see it on credit. We don't see the mortgage on the credit. So yeah. Does not that would exclude you from being a first. No, you'd still be a first time home buyer. You'd still be a first time home buyer. I believe 99%. Somebody will tell me.
So
Somebody hit us up if I'm wrong about that.
now, do you know what are some of the benefits of being a first time buyer? Because sometimes, me speaking to the people, the buyers think like, me being a first time buyer, they give me the house for free and I don't have to make no payments. There's like so much benefit to being a first time buyer. Like, what are some of the benefits for first time buyer out there today?
The benefit? Well, the
Yeah.
benefit, the benefits are you can, again, there are these programs. You get a preferential interest rate. You can put down less money, right? As little as 3% down. VA loans, I don't know if you know, VA, you could put down 0%. I think you know that, right?
Yeah.
VA loan, 0% and no MI.
And no closing costs either, right? I mean,
incredible. So low interest rate or lower interest rate, down payment assistance, 3.5% down. I mean, those are really the good things about it. Yeah.
I love it. So anything else, P, you would like to leave with us? I know we have about 5 minutes to go.
Yeah, I would say to folks, right, if you're looking, before you go looking to buy, get properly pre-approved. What's the minimum you have to live in the home if you're going FHA for the minimum? It's a good question, Josh.
Before, if you can clarify, is it before selling the house, refinancing, like?
Oh, that's a good point, John. Right.
Yeah.
I was thinking, I'm feeling like he's talking about moving out, like buy the 4-family, stay in it, and have to move out. Am I right, Josh?
I mean, you can move out anytime you want, but
yeah, I have been told by an attorney, and I won't mention names, that typically you need to stay in the home for a year, minimum for a year, before if you're buying it as a primary, you stay in it for at least a year. Yeah, I'm right. Okay.
Yeah. So moving out and buying another one. Okay.
Yeah, that's what I was feeling. So typically, you know what? I'll look it up. I'll get back to you on that, Josh. But I was told years ago by an attorney, a year. Same for an investment property. You buy it as an investment, typically a year. Now, I think that the bank has I got to check. I got to get back to you on that.
And I think also case by case, if there's a need for you to move out sooner, right? That's fine.
Yeah.
You can do so as well.
So I would say very important, especially for first-time home buyers and realtors. I'm going to say this realtors too. Get people, especially today. I'm telling you, John, you let me know if you're not seeing this more often. That just to get into a house today, people are saying, I need to see a pre-approval. A listing agent, a seller, I need a pre-approval. Just to see a house. Am I right?
Yeah. I mean, it's obviously, though, why would you go to a restaurant without your wallet? How are you going to pay for the food? It doesn't make sense.
Yeah. So my thing is, I say to people, listen, get pre-approved, not pre-qualified. Difference. Pre-qualification means I just giving you verbal information, and based on my verbal information, you tell me I can buy a house. That's good, but it ain't great, and it's not what the seller or the seller's agent wants to know. When you're selling a house, John, you want to know when you see a pre-approval letter. I bet you sometimes make a phone call unless you know who that loan originator is, and you quiz that person. Did you see the assets? Did you see the tax returns? Did you see the pay stubs? Did you go through everything? Did you run the credit? Did you review everything? Because when I take this deal and I bring this to my seller and I bring in the offer, I want to make
So
sure that this is going to go
I
smoothly.
just want to change. I just want to change the question. So don't ask. Have you seen the credit? I would say, what is the mid credit score? Don't say, have you seen the bank
You're right.
statements? And
You're
say,
right.
how much money do they have available now in that bank account? And is it in one bank account or is it in multiple? And not only, I'm always looking not just for the answers, but how quickly the banker is able to provide me with the answers and
Oh,
what sort of wisdom he's also sharing with me behind what he knows, right?
go
Like
ahead, John.
I want him to wow me and be like, oh my God, I can learn so much from this guy. Like this guy knows what is he talking about, right? Because I think, not just to get people pre-approved, because honestly, there's different things which they come into play, and the customer might seem pre-approved at first, but then you get to find out some things, maybe something is credit, or maybe the employment history wasn't really solid, or maybe it's a VA loan and he bought a home less than 2 years ago, which was FHA, and he gonna use the FHA loan again, right? Like little things like this, which is not that's not a common knowledge when you're qualifying the buyer. I think this is something which you have to learn through experience of doing more loans and constantly really educating yourself, right? Because the policy is changing. The policy is changing all the time. And if us or the banker who you're working with just doesn't have the most up-to-date information,
Yeah.
you might be taking a customer in the wrong direction, right?
What happened?
So you might be taking a customer in the wrong direction, right? Like if you don't know what type of program he's gonna be in, you might
Yeah.
put him into the wrong program for a month and a half, and then you find out like, oh my God, he doesn't actually qualify for a FHA. He could qualify for conventional loan, but for this and that reason, he just can't qualify for FHA.
Yeah. Yeah. And it's important because it's also our reputation, right? When I put my name on a piece of paper on a pre-approval letter and someone
Yeah,
goes out and I get a phone call from the listing agent or from the seller, um, I better know what I'm talking about. And you as a realtor, as an investor, as a broker, you're banking on me that I can sell your client, right? So get the docs up front, know what you can qualify for, know what homes, neighborhoods you should be looking in and where you shouldn't be looking. And when you're ready to place your offer, the only thing that the mortgage loan officer needs is an executed contract, and boom, they're off to the races and they get you a loan, because that's what you want, right? You want it to happen. Everybody wants that to happen smoothly. So I can't stress enough to realtors as well, before you take people out, get your people properly pre-approved, because I listen. I learned the hard way, where people got into contract and I did not do my due diligence. I did not do it. And I'm like, oh my God, look at all the bank statements, all these large deposits and this cash. Where did you get this cash from? Cash will kill the deal, as and then you just get issues with credit, and now you gotta backtrack, and that upsets everybody. That upsets everybody.
yeah.
So,
Now,
John, I
Pete, this
see
was
our time
great.
is coming to an end.
Thank you so much. I really appreciated you, my brother. As always, guys, if you find this helpful, give us thumbs up, give us some hearts as well, and we'll see you on the next one. Peace out, guys.